Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello,
Hey Danielle, it's Aki.
come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LQ.
Can I take her out for a spin?
Please.
LEQ, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ,
Yes,
schedule a doctor's appointment.
no problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
Well, I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's a reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. It is Monday, March 20th, 2023, live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Tim, as you know, on leave. I'm Carol Masser, along with Bloomberg News Deputy Team Leader for U.S. Equities, Jess Manton, doing duty for Tim on this Monday. And Jess, bit of a relief rally when it comes to U.S. stocks. Yields backing up a little bit along the curve, thanks to global regulators coming together over the weekend to calm markets. I do feel like they'll untap this week a lot.
This is a big week, and especially with all eyes obviously on the Federal Reserve on Wednesday, Carol, and of course the man himself, Fed Chair Jerome Powell, what he's going to say that afternoon.
I can't wait for the Q&A session of that decision. With all of that in mind, we've got a banking roundtable with the latest on Credit Suisse, First Republic, SVB, and more. What you need to keep on your radar as this continues to unfold. Plus, the founders of the VC firm Kapoor Capital on SVB and closing the equity gap. So I like that we keep taking this tech and entrepreneurial and Silicon Valley aspect of the story.
Exactly. And also we're going to be diving into the importance of two of the world's most visible and controversial leaders meeting this week. Also, Amazon cutting jobs again, Carol, and a check on the consumer with the CEO of one very consumer discretionary stock.
We're looking at everything from very different angles. All right, folks, let's get you going though with a quick reminder of where we are in terms of the trade. And we're bouncing around, but we're definitely staying just off our highs of the session. What does that mean? Slight gain on the NASDAQ and up about 0.6% on the S&P. If you really want to find some outperformance, just go right, just to those bank stocks, whether it's the big bank stocks, many of them, and a lot of the regionals.
Right, even though First Republic under a lot of pressure, again, down 30%, but still when you're looking at these other lenders, whether the regional big bank stocks, those are outperforming. And especially, I think some people would be scratching their heads if you're looking at the S&P 500 right now, 10 of the 11 sectors higher, driven by energy and materials.
All right, folks, right now we're going to head over to our TV colleagues, Romaine and Katie. We've got Countdown to the Close starting right now. It's Monday. What can I tell you, everybody?
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic and Katie Greifeld here. Happy Monday. We're joined right now by our colleagues Carol Masser, Jess Menton in today for Tim Stenivek. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Carol Masser, it's been an interesting weekend. I think, of course, with the UBS Credit Suisse deal, and now a lot of people looking here in the U.S. to see how our banking system resolves some of the issues still lingering.
Yeah, our banking system, and I feel like the global banking system continue to do what it needs to do to kind of calm everyone down. You just had a headline crossing the Bloomberg, the Federal Home Loan Bank issuing in 1 week $304 billion as banks bolster liquidity. So we continue to see moves to shore up the system. Having said that, it does feel like a little bit of a risk on trade if you look at what's going on in crypto again.
That's a lot of money, though. I mean, you're just kind of skipping over that. I mean, they had, that was like
it's a lot of money.
Yeah, I mean, they had $800 billion as of last year for a full year here, and you got $304 billion in a week.
Yeah, it's a lot. Okay, so that's really smart perspective. Sorry for skipping
What's going on
over
with crypto?
All right, so let's talk about crypto, everybody, because it does see, we are seeing kind of some separations in trade where there's some risk-on trades, big banks, regional banks doing well. Let's take a look at the crypto segment, because you've got Bitcoin, up about 0.4%. It's been bouncing around, but it's topping, as you can see, 28,000 for the first time since June. We're up 5 days in a row on Bitcoin, up around 70% so far this quarter. So some of it has to do with maybe a dovish Fed, that risk-on trade, as I said, and that turmoil in the banking sector really looking, investors looking at some other options. So look at some of the crypto names. Bit Digital's up 2.3%. Riot Platforms up more than 7%. eBank's up about 1%. But I should point out, just not all names. We saw Coinbase, Marathon, some of the other names seeing some pressure today.
Exactly. And I have to point out what's happening with the 2-year Treasury yield. Looking at that, hovering again, still below 4% after posting its biggest weekly decline in more than 3 decades. It's dropped more than 70 basis points last week and around 100 basis points in just the past 2 weeks alone. And that's important because 2-year yields have often peaked at or above the Fed's terminal rate. So that's going to be something key to watch moving forward, especially ahead of the big Fed decision on Wednesday.
Yeah, the banking crisis, though, is not over. You are seeing green on the screen across the board here as people do pile back in to some names. Energy and materials kind of leading the charge here. You got an S&P up about 0.7% and the Dow up about 1% on the day. Similar story for the Russell 2000. The NASDAQ only up about 0.2%.
And if we look at the sectors, all 11 are in the green right now, but just barely. You have healthcare leading the way, or rather, you can see energy is up there, which is interesting. You also have materials, industrials. You look at what just nudged into the green just as I'm talking. Information technology, big tech had been the leader, but now it's the relative underperformer, but remains still in the green, just barely.
Yeah, let's take a look at some of the individual movers. One of the big stories of the day, if there weren't a banking crisis going on, would be the Amazon announcement, confirmation here of about 9,000 additional job cuts here. Those shares down about 2% on the day, though they had been rallying a little bit earlier here. And then keep an eye on Bed Bath & Beyond. It is now a penny stock trading at 81 cents a share. It's down 22% on the day, but this is significant here because remember, there was a threshold here that they had worked out with bondholders and equity holders here with regards to valuations. That was at $2. They managed to negotiate that down to $1 a share, and now trading below that. So effectively, they need to go back to the negotiating table with one of its main holders, Hudson Bay Capital. It'll be interesting to see what the future of that company is. And as far as the bank stocks, a tale of two banks here. First Republic down 43% here on the day, while New York Community Bancorp up 33% here on the day here, moving in different directions here. And I want you to flip it up real quick because we do need to go over to Europe here and talk about some of the sell-offs that we've seen and some of the tier one capital bonds out there and a lot of the pain that a lot of bondholders over there are concerned about right now when it comes to whether they will be usurped by anything going on with the regulators.
All right, so great setup, right? And certainly this is something that the Fed needs to think about big time when it goes into that meeting next week. Do you have another chart for us?
No, that was the chart.
Was it?
Keep going.
Are you
Keep going,
sure?
Carol.
You're showing another chart. I don't want to mess you up here. All right, listen. What's going on with the banking situation? Certainly going to be top of mind as the Fed meets, kicks off that two-day meeting tomorrow. But former Federal Reserve Bank of New York President Bill Dudley, he's a Bloomberg opinion columnist. He caught up with our TV gang earlier today. He reminded all of us that the Fed kind of has a couple things on its plate, two things to think about: what it does with rates. Maybe nothing. Okay, and then it's also got its massive, what is it, $8.6 trillion on its balance sheet. Here's what he had to say.
I think this is about exceptional liquidity, lender of last resort provision to support the banking system. I think quantitative tightening, the runoff of the Treasury portfolio and the agency mortgage-backed securities portfolio is going to continue unabated. I see these tools as very separate and different. So I expect that quantitative tightening will continue. The case for zero is do no harm. We know that the banking system's under stress. So why would you continue to raise rates when the banking system's under stress?
All right, former New York Fed President Bill Dudley, also Bloomberg opinion columnist earlier on Bloomberg TV, but it's just a reminder, right, that there's these two things going on that certainly will impact liquidity remain within the system.
Yeah, absolutely, and I mean, I don't think anybody's thinking that balance sheet is about to go anywhere, or at least meaning not down anytime soon. And I think that the headline, and I was kind of teasing you about it, but that home loan, what we saw out of the federal home loan banks,
it's huge.
It's huge, and we're talking about just in a single week more than we had in the previous month, and of course, it's like a third of what they had entirely over last year here. So the idea here is that there are folks out there basically using this as a backstop, basically using this as a lender of last resort, which is not intended to be. So at some point, that means that the rest of the federal government, meaning the Fed or someone else who are supposed to be that lender of last resort, who are supposed to be that backstop, need to come out and say something.
And it's really interesting where the banks are actually seeking help from to that $300 billion figure that we're speaking about from the Federal Home Loan Bank System. That's nearly double what those lenders tapped from the Federal Reserve. So clearly a lot of uptake here, maybe not as much as expected from the Federal Reserve. It's interesting.
It is, and especially with all eyes also on the dot plots on Wednesday with its summary of economic projections, with Barclays thinking the median projection for 2023 would be at 5.1%, which is actually where the Fed had it at that December meeting.
I can't help but feeling like, are we turning on the spigot again?
Yes.
And so we're just creating another,
Well, that's the fear.
It's not like 15
longer.
years, though, until the bubble burst.
I mean, Carol, come on.
I know.
This is our economy.
I know.
We're not a free market.
I don't know. Whatever happened to capitalism? Like
No.
you make mistakes, you kind of dropped, you fall. I'm just going to say. All right.
That's an interesting question.
Sorry, I'm feeling in a Monday kind of cranky kind of mood. So we're going to continue. I'll
Why?
try it. I'll
Today's
work
the first
on
day
that.
of spring, by the way. It's spring
I thought that was tomorrow.
It's called the Northern Hemisphere.
The 21st. The 21st. The
It's here.
21st. It's tomorrow, Katie, but we'll let
It's not.
Romaine believe it's today. All right, everybody. We will be back in less than an hour's time. We're going to continue this conversation.
We'll correct to them when we come back.
I hear nothing. Radio, TV, Bloomberg Originals, and of course on YouTube, Beyond the Bell. Catch us at 4 p.m. Wall Street time. Same with the big banks, although it feels like most of the big banks holding up. So lots of news coming out. You've got UBS's plans to take over Credit Suisse with an assist. We know about that. We've got New York Community Bancorp surging by record, leading that broader rally in regional bank stocks after the lender was upgraded by at least 2 analysts following its agreement to take over Signature Bank's deposits and some of its loans. Meantime, First Republic Bank still having a tough time extending its route to an all-time intraday low. So let's get to it. Carol Masser here with Jess Metten, and let's get to our roundtable. Back with us is Allison Williams, Senior Global Banks Analyst on the phone, Herman Chan, Senior Analyst for U.S. Regional Banks, both part of our Bloomberg Intelligence team. Herman here in our Bloomberg Interactive Brokers studio. I want to start with you, Herman, only because we did have some headlines a short time ago. First Citizen saying it's continuing its pursuit of Silicon Valley Bank. Remember about SVB? That's still out there. Tell us about this, the significance of this and the importance of this, and maybe starting to calm things down.
Yeah, I think what we're seeing is that we live in a capitalist society, and banks will fail. That's natural.
You heard my soapbox
yes,
thing
exactly.
about capitalism.
Banks take risk, and inherently, sometimes those risks will upend the bank, and they fail. So what we're seeing is natural, where other stronger, supposedly stronger banks will come in and take over the failed institution, which I think is a vote of confidence that the system still works.
And that there's a bank out there that feels comfortable enough to do it.
Exactly, and the regulators feel comfortable with that bank to take over. So what we're seeing with SVB and First Citizens is, it seems like First Citizens really wants to expand. They've been in expansion mode for a bit now. They bought CIT not too long ago, a specialty lender here based in New York and New Jersey. So they have wider ambitions, and I think SVB fulfills those potential ambitions. But we'll see if the regulators let them close that transaction.
Allison, I want to bring you in the conversation because when we're talking about New York Bancorp and then Signature Bank, is this a guide for how more banking deals can be reached?
I mean, I think to Herman's point, it could be a great opportunity for both banks, for those that have gotten themselves in trouble with mismanagement, being taken over by a stronger, healthier bank that perhaps has a little bit more prowess in terms of managing those risks. It's good for both of those banks and good for the system.
Allison, how do you see like JP Morgan holding up certainly 0.8% higher in today's trade and bringing up Bank of America? It's down a little bit. Goldman Sachs, what's going on? Up 1.6%. And let me just pull up Citi. Citi just down about 0.6%. How are you looking at it from the big bank perspective as we are focusing so much on the regionals?
So I think certainly this time around, if you will, the crux of the issue, which really relates to mismanagement of bond portfolios, mismanagement of sort of we have this big blow up of deposits and the bond portfolios. Has really been an issue centered on the regional banks. For the largest banks, they're actually benefiting from some of the deposits. A couple of them are very unlikely to be acquirers because once you're over 10% of deposits, you are not allowed to. The understanding is that during a crisis, they will be allowed. We did see a few deals happen last crisis where that 10% was breached, although there's some nuances around those. But for the bigger banks, Credit Suisse was really, I think, the one that people were watching. That's really when you started to see the bigger banks selling off last week, was when there started to be rumors about Credit Suisse's outflows. People were concerned about counterparty risk, but since that was such a longer developing story, unlike Silicon Valley, which happened in a day or so, most of the banks had managed down that risk successfully.
Herman, I wanted to ask you specifically because this was a striking number. Looking at the $17 billion of Credit Suisse's risky bonds that are now basically worthless, what are the wider implications for bond markets moving forward? Because it seems like a controversial deal if you're a shareholder versus if you're a bondholder, right?
Yeah, the AT1 issue, I think, is unique to Europe. Historically, when you do Finance 101, if something happens with the company that you own, the equity holders usually get wiped out and the bondholders get a certain percentage based on your seniority or priority in your capital stack. So it seems very unique. I know my colleague Arnold Kakuta had mentioned that the Swiss regulators and the Swiss version of these AT1 bonds are a bit unique versus the rest of Europe. So that's something I would point to.
Hey, Herman, First Republic, down 45%. So
Right.
what's the likely scenario? And this is after what? You know, credit rating lowered again by S&P, $30 billion infusion last week. We got some more clarity about how many times it's been tapping into funds. I mean, do we know what the likely outcome is here?
I was expecting some sort of news from First Republic or the regulators over the weekend. That didn't happen. From what I've read, it seems like management is a very proud sort, right? The CEO is the founder of the company, has been through multiple cycles, nurtured this company to become one of the biggest U.S. banks in U.S. banks.
Right.
So.
Is that the problem, that you've got leaders that are proud?
I think so, because the issue is, the hope was that this $30 billion deposit injection would calm the markets. Obviously, that hasn't happened. And management, I feel like, is now put into a corner, and they really have to make a decision on what's really best for their customer and the bank.
Both of you, I want to ask you, there's a great quote this morning about bank failures. I think it was on Surveillance, and it was somebody, a guest said, likening them to cockroaches, and basically say, when you see one, even if you don't see another, you know that there's hundreds behind the walls. And I guess our mission, all of us right now, is to figure out if that's the case when it comes to more bank failures. So Allison, how are you thinking about your sector, or the counterparty, exposures, if you will, to figure out exposure or what could go wrong next? In other words, finding that next cockroach.
Well, I think what's worrisome at this point is just that the market sentiment can drive reality, and so I think that's the concern. So if we look at Credit Suisse, the regulators were in there, the capital was fine, the liquidity was fine, but if the rest of the market worries, it creates an issue, and the Swiss regulators pointed to the fact that that it was really the outflows they were seeing that caused them to step in. There were reports of them receiving about 10 billion of outflows a day, so obviously that's significant. And so I think that, to your point, investors are looking for sort of the next bank at risk each time something happens. And I think that it's tricky for regulators because they do need to come out and do something that's enough to make people steady sentiment, but not too much that makes people nervous that there's more to be worried about. So sentiment is a tricky thing.
Same question to you, Herman. Like, how do you think about what could go wrong next? And I feel like, it isn't quite whack-a-mole when it comes to the regional banks. Maybe it's a slow-moving game of whack-a-mole.
I think initially it was whack-a-mole with SVB and Signature. Now it's more of a, okay, we know First Republic is the main issue now that the market is focused on. Is there anything else? Is there another?
Western Alliance we're not worried about or anything? Or
Western Alliance is a name that continues to come up.
PacWest?
PacWest is a name that continues to come up, but two banks that operate in California and the West Coast. I know Western Alliance a bit better. They offered a pretty decent update in terms of their balance sheet and their cash position on Friday, so I think that placated some folks. So. Really, what's the next shoe to drop? I think what Allison said, market sentiment creates reality. And you look at a bank's typical balance sheet, you don't mark to market their held to maturity securities, you don't mark to market their loans. That's a feature of bank accounting, but the market is saying that's a bug. And so we're in this weird position where we have to question, what was inherent acceptance of how banks manage their balance sheet, and that's really upended with what's happened with SVB and First Republic.
And we've definitely had regulators coming out and just throwing, it feels like, a lot of money, thoughtfully, into the system. Allison, just got about 25 seconds. The big banks just get even bigger and bolder and more powerful?
They do. I mean, that does seem to be what's happening. And I think, again, I think what everyone's waiting to see is that there will be some kind of announcement on deposit insurance, which will really make things interesting, especially because the big banks pay the most for that. But regulators are going to want to, protect the smaller banks. And then globally, what does that mean for global deposits if the U.S. effectively insures higher amounts? Does that attract even more to those big institutions?
I don't know if your boss has told you guys, but you guys get this big Caribbean vacation after all of this is over because you're working.
I'm cashing that in.
Or so I heard. Sources according to Allison Williams. Thank you so much of Bloomberg Intelligence, and Herman Chan of our Bloomberg Intelligence team following the big banks and the regionals. You are listening and watching Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 3:20. 2021 on Wall Street. I'm Charlie Pellet. We check markets all day long here at Bloomberg. We have got 39 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ, all in the green. Stocks are advancing right now. Regulators worldwide rushing to shore up market confidence with the recent financial turmoil spurring speculation on a slower pace of tightening from major central banks. But what about market sentiment given the issues in the banking sector? Mona Mahajan is senior investment strategist at Edward Jones.
We do think that this is very different than the situation we saw back in 2008. And of course, it might be evoking memories of the financial crisis. But of course, large banks here in the U.S. are better capitalized. They have more diversified revenue streams. They are more regulated, and balance sheets are looking much better. So very different situation, we think, not necessarily as a systemic risk that we saw back then.
In the meantime, shares in First Republic Bank are plunging again today as S&P Global cuts its credit rating for the second time in a week. Shares of First Republic, they're down now by 45%. Heading in the other direction, New York Community Bank Corp surging after taking over Signature Bank's deposits and some of its loans. NYCB up now by 33.5%. S&P up 23, up 0.6. The Dow up 287, up 0.9. NASDAQ up by 0.1%. 10-year yield 3.47% with a 2-year 3.92%. Spot gold down 0.4%. We've got gold $19.81 the ounce. West Texas Intermediate crude oil up by 1.3%, $67.59 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, along with Bloomberg's Jess Metten, here in our Bloomberg Interactive Broker studio, streaming on Bloomberg Originals and on YouTube. So, yep, we know it's all about banks this week, including with this week's monetary policy setting meeting by the Federal Reserve. Kicks off tomorrow, decision on Wednesday. Based on our latest MLive survey, there seems to be some disconnect, though, Jess, with what markets are showing about the trajectory of rates and what investors expect, right? That makes it just even more confusing.
Exactly. Where are things moving forward? If financial conditions are essentially tightening, does that do the Fed's work for them?
It's a really good point. So let's bring in someone who follows this closely. Liz McCormick is Chief Correspondent for Global Macro Markets. She's here in our Bloomberg Interactive Broker studio. Great to have you here. We keep kidding that you are among those probably not getting any sleep. So tell us about the MLive survey and who we talked to and what we found out.
Yeah, so first of all, this was very cool. I got to work with Anna Wong, one of our faves here, economist for us. And now I will say this survey was done when the U.S. banking side started to rumble, but not with the like UBS buying Credit Suisse. So there are bits and bobs they didn't have. But Anna and I were like a little bit taken back that despite this, they seemed to think like soft landing may happen, like the Fed could eke out a little bit more hikes, but they're not, you know, they were like the greatest percentage said soft landing, which is a little surprising, you know, and who knows, like we were saying earlier, like we were like, oh, things may not be that bad. Now they're unraveling. So from day to day, the world changes, it seems, you know, but they seem to be a little bit, you know, less fearful than some of the contagion fears in the market, saying, you know, maybe the job market holds up pretty good and the Fed could tighten a little bit more. And they surprisingly had confidence in the Fed. You know, you hear a lot of Fed bashing, but the survey had the highest percentage saying that, you know, the Fed has credibility, you know. So.
Yeah, and that's exactly what I was going to ask you about, the credibility question and what that's really suggesting to us on Wednesday when we do hear from the Fed. What do investors think the Fed should be doing?
Yeah, I think they think it's, although you know, like I'm happy to, you know, be hard on the Fed, but I would not want to be Jay Powell on Wednesday.
Agreed.
But I think the survey respondents think they will hike maybe a little bit, you know, quarter point. Although the market now is priced for that. There's many you've talked to them economists now saying we're going to have a pause. So I was looking at the guys at BMO. They always have fun notes, but they were saying, hey, listen, just because the market's priced for a 76% probability of a quarter point hike does not mean it's consensus. There's so many ways this can go. So I think the survey respondents were kind of getting to that. Like, hey, I think there's maybe another hike, and, you know, Fed has credibility, which I think, Jess, has to do with them thinking, you know, maybe they were a little slow, but they did come out to fight inflation. But, you know, like those long and variable lags, right? We're seeing the ripple effects of that, you know, the pain.
How do you think about it, you know, Liz, in that there is an opportunity for the Fed to say, and rightfully so, even in the press conference, I think, with Jay Powell, to say, listen, we got some stuff going on. We are that hawkish pause. We still know we're bringing down inflation. That's still our mission, but let's just take a breather here. I mean, there is that door easily for him to walk through and do, isn't it?
Yes, and other Fed chairs have, like Volcker, even during his time, they had to take a pause. And so, I mean, they definitely...
In his rate hiking cycle.
Yes, yes. So they definitely can do it. I think maybe it was Bill Dudley speaking, or someone was saying how, which I thought was a smart point, if they pause, they have to be clear to say, just like you're saying, we're taking a pause, financial stability concern, but we have more work to do. I think that, and they can communicate that, but there's definitely many saying they could pause, but not like signaling this is over, because inflation is still not where they want it to be. Although all of this, like I was talking to Daryl Duffy the other day, smart guy from Stanford, who said, I'm not saying this is a good thing, but if you said any silver lining of this is it is deflationary because credit conditions will tighten, growth will slow. We already see break-even inflation measures coming down. So that has, like Jess was saying, done a little bit of the work for the Fed. So if they do pause, they don't have to say we've got tons of more work to do, but they might want to make it clear. We're not saying all's over, but they are getting a little windfall from the lower inflation stuff.
Not scientific. Don't ask me about standard deviations. But I did do a Twitter poll, and I said Fed should raise rates. And I gave them an option of saying they shouldn't, 25 basis points, 50 basis points. Almost 52% said 25 basis points. So people do think that the Fed should still do something and act on their mission.
Yeah, I mean, Christine Lagarde did 50 last week, right?
And we survived.
Yeah, we survived. That's what I was thinking about. We survived. That was just what I thought. And although she had been clearly telegraphing another 50s coming, so maybe it's a little bit not a perfect comparison, but I think it was probably helpful to the Fed to see that in the rear view, that the ECB did 50 and the market survived. And I mean, they came out this week in the coordinated central banks on the dollar swap lines, which is more support. So I really don't think that the world will implode if they do 25, and maybe that's what they all come to, that it's too much risk if we stop. I mean, I'm not sitting in that room talking with all of them, but I think, there's, and they always like when the market's on their side. The market is pricing in a quarter point, so that they don't like to surprise the market. So if there was like 0% odds of a hike, then it'd be even tougher for them, right?
Yeah, and everyone obviously coming into this year debating about a soft landing, a hard landing, a no landing. I know you've covered this so extensively. When you're looking at the bond market, what is it telling us as far as how the trajectory of the economic cycle could potentially change when we do have these bank stresses?
Well, it's interesting. I really think the market, as we've talked before, probably all of us, on the inverted yield curve. Been inverted for a long time. It's usually a good harbinger of a recession. The market is pricing from the peak, say around May, in the funds rate to the end of this year, over 3 quarter-point cuts.
I can't even
get my
it's
head
amazing.
around that. So, but I think that's about pricing in a recession. I don't think it's pricing in a hard landing, like dire conditions. You would say Fed's got to cut over 100 basis points, et cetera. So I don't think they're doing the no landing anymore. It's amazing how quickly that kind of vanished, right? But that's what, Jess, I think the inverted curve, although it's steepened a lot in recent weeks, I still think there's enough cuts priced to seem to signal some landing.
And typically you would see it steepening later in an economic cycle, correct?
Right. But like I was talking to a hedge fund person the other day, and she was saying, I'm really watching the curve. If it continues to steepen, that usually shows the inflection point. Like we're at the worst, like the Fed's going to start to turn the other way, because the markets are always kind of ahead. So that's going to be the question. This 210 curve, which has steepened a lot, still inverted. What happens after Wednesday? Does whatever the Fed does kind of invigorate the flattening, or does the steepening go? So I think that's what we're trying to figure out. I think the Fed is going to be hard, like you said, Carol, that to kind of signal we're done for good, even if they pause. So I don't.
That we're done for good? What do you mean?
You mean done for good in hiking?
Oh,
you know what I mean? I think even if they have that inkling, I don't think they want to foreshadow that.
Well, and saying that, I'm like looking at your story. I mean, this whole idea, and we keep talking about this, the importance of how psychology becomes a fundamental driver of markets or expectations. And I do think about what the Fed, what they do, and then versus what he says, to just find that sweet spot.
Right.
It's not easy.
And not to fault him, but there's been a few fumbles, right? Where,
it's fair.
People said, oh, what did Powell say? It didn't quite work. So I think it's, the bar is high for him.
Or the decision comes out one way, right? And the Q&A goes a different way.
And then everything's good, and then Chairman Powell talks and markets go crazy. So I'm sure it's hard for him. He has his talking points, these barrage with questions from reporters, including ours, you know. So, but like in this story, Greg Peters of PGIM, who I think is a smart guy, been around
Greg
for a
Peters.
while, he said, listen, Liz, contagion is not rational fear. You know, like it's people pricing in irrational things. So you can't even model that. So that's the scary part, right?
Well,
You
and I
know?
agree, because when that starts to get out of control, right, you can just see kind of like a runaway train in the markets.
Yeah, and we were just talking about the psychology of it, the whole buy the dip type of mentality. How does that play into this now where people may not have been used to that? Obviously, they're just used to that and they didn't go through, say, the global financial crisis in 2008.
Right, yeah, and they haven't seen, that's why for a while I was saying when rates were going up, even though it was painful, like, hello, maybe if you were around longer than 10 years or so, rates were a lot higher, not to date myself, but that people weren't used to higher rates and they thought, you know, oh, and the Fed always swoops in and saves everything. I mean, stocks, you know better than I, Jess, that it was like buy the dip was working so good for a while, and then that kind of like faltered, right?
We need to remember that what we've lived through in the last decade has been the abnormal environment. I mean, we're kind of going back to a more normal one. Thank you so much. I say it a million times, but you do make us smarter. So, Liz, thank you so much.
you,
Liz
God.
McCormick,
Ladies.
she's chief correspondent for global macro markets at Bloomberg News here in our Interactive Brokers studio. Be sure to check her out on Twitter at McCormick Liz. All right, right now, let's get a check on world and national news. Off to Nancy Lyons in our 99.1 newsroom in Washington. Hi, Nance.
Hey, Carol. As China's President Xi Jinping meets in Moscow with Russian leader Vladimir Putin, America's Secretary of State Antony Blinken is expressing skepticism about China's purported goal of negotiating a peace treaty between Russia and Ukraine.
The fundamental element of any plan for ending the war in Ukraine and producing a just and durable peace must be upholding the sovereignty and territorial integrity of Ukraine.
But Blinken says a ceasefire now would allow Putin to rest his troops and then restart the war at a time more advantageous to Russia. Xi is in Moscow for the next 3 days. Former President Trump says he expects to be arrested tomorrow in the hush money case involving porn star Stormy Daniels. He urged his supporters over the weekend to protest, but there's been no confirmation from the New York District Attorney's Office. Trump's former chief of staff, Mick Mulvaney, tells Bloomberg he does not see overwhelming support for the former president on this.
The response that I've seen online has been much more tepid than I think people realize. Even folks who might have otherwise sort of come to his, you know, the patriot moat around Mar-a-Lago may have learned their lesson on January 6th, which is that you may end up going to jail, and the president's not going to protect you.
Mulvaney calls the potential charges bizarre and says it makes it easier to accuse the DA of making a political statement with any arrest. Ted Lasso, also known as actor Jason Sudeikis, gave a mental health pep talk today at the White House.
Big theme of the show is like to check in with your neighbor, your coworker, your friends, your family, and ask how they're doing and listen sincerely.
Sudeikis and some of the other cast members of the Apple TV hit Ted Lasso were invited to the White House to highlight mental health issues. Ted Lasso experiences a panic attack on the show, which leads him to seek mental health counseling. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We check markets all day long here at Bloomberg. 20 minutes to go ahead of the closing bell. Stocks are higher for now, so let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
Good afternoon, Charlie. Stocks are gaining as those banking jitters ease. The Dow is up 350 points, S&P higher by 30, with the Nasdaq climbing 30 points. The U.S. 10-year yield is at 3.47%, and small caps are up 15. All 11 main S&P sectors are trading higher, led by gains in energy and materials. Tech and consumer discretionary are the day's worst performers. Nasdaq Biotechs rise 40 points, transports dip 10, semis are higher by 25, while the VIX is lower by 5%. Leaders in the Dow, Caterpillar, Honeywell, and Dow Inc., while Microsoft, Intel, and Salesforce are the only stocks in the red. Regarding bank stocks, UBS erased a 16% slide to rally as investors weighed its Credit Suisse takeover. New York Community Bank jumped by a record after a takeover of Signature Bank's deposits in some of its loans, and First Republic sank as much as 50% as S&P cut its credit rating for the second time in a week. In other news, Amazon will cut another 9,000 jobs, adding to the largest round of firings in its history. Wrapping things up, Bed Bath & Beyond hit a record low, putting a financing deal at risk. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey. And to hear live breaking news over your Bloomberg, type SQUA, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week. It is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Thousands of small businesses benefited from a payroll tax refund and beat the odds of shutting down their organizations. This refund is not a loan and could help your business specifically weather rising inflation and supply chain issues. To learn more, just head to getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we are counting down to the close. Just about 17 minutes left in today's trading session. Carol Master along with Jess Menton. So let's get to it, and let's get to our Drive to the Close guest. Paul Bayaki is with us. He's Chief ETF Strategist at SS&C Alps Advisors, a registered investment advisor. They've got some $19 billion in assets, over $19 billion in assets under management. They are based in Denver. Paul joining us, though, in our Bloomberg Interactive Brokers studio. So nice to have you here in studio. First of all, you come to New York. How does the conversations differ from when you are back at headquarters in Denver? I always love when people are coming from different parts of the country.
Well, I would say broadly the conversations are similar. You know, Denver has.
Are people nervous?
People are nervous. I think the reality is Denver's grown. It's one of these cities like Boise or Nashville that you hear a lot about, people moving from the coasts to some of these cities. And so I think there's been a diversity of the population that maybe didn't exist 5, 10, 15 years ago, not just in terms of demographics, but in terms of background and in terms of the places where people grew up. And so I think that feeds into it. But you come to New York and there's just this energy here in this city that doesn't exist in other places. And because you're having conversations with people who grew up here in many cases or who have spent years in the business here, there's a seasoned nature to some of the people you talk to about some of these things. Been there, done that sort of thing.
So as you come to New York and you're having meetings, are people pretty calm about this environment, or are they suspect?
Well, we'll see. I mean, I flew in last night, so I've got some meetings
early.
the rest of the week. We'll see. But I think that's the tone. Even internally, we've had some calls. We had one of our fixed income managers going through their outlook. We had a commodities manager going through an internal call this morning. And I think the idea is look, these are, in some cases, idiosyncratic dynamics. But in other cases, they're a symptom of what has been a pretty dramatic change in capital markets dynamics that we haven't seen for quite some time. And so I think some people are just sort of in wait and see mode.
And especially because you are a strategist for ETFs, I was curious as far as what are the flows telling us? Do you have exposure toward banks? And if so, what is it showing us so far as like following the money at that point?
Yeah, so we're a distributor for the Select Sector Spiders, which are the largest, most liquid sector ETFs in the marketplace. And last week we saw a lot of flows into XLF, believe it or not. And I think
Really?
you think about what XLF is, and it pulls from the largest financial companies in the United States in the S&P 500. And what we've heard anecdotally is people who had deposits at smaller regional banks starting to move their money to some of these larger banks. We heard Congress talking about it, concerned about it, and what the impact might be, bigger banks becoming bigger. And we saw some people perhaps moving out of their regional banking exposure into these larger financial companies within XLF. We do have some other products that are more diversified that have some finance exposure, but by design don't have that regional banking exposure. So one that we were talking about on the TV side earlier was OUSM, which is a small cap strategy focused on quality, income-oriented, low volatility stocks in the small and mid cap segment. And if you look at the Russell 2000, which is the benchmark most people use in the small cap category, about 9% of that portfolio is in regional banks. And OUSM, relative to that index, is underweight financials, but doesn't have any regional banking exposure. It's got capital markets and insurance companies. If you look at the Russell 2000 value, it's got 18% in regional banks. So it really comes down to investors waking up to the reality that in some cases, they don't know they have exposure to some of these companies. They don't know that they have exposure to some of these segments of the financial sector in portfolio categories that they didn't anticipate. And that's part of the know what you own and why you own it.
Well, and it's interesting, going back to flows, as you said, there was money coming into the XLF. Is it continuing to come in? The longer this goes on and the more that we are, the continuation that we are, talking about what's going on in banking, does it still come in?
Well, it's a challenge because XLF is one of those products that's used by such a wide range of investors. You've got hedge funds who use it, pensions, endowments, retail investors, advisors. And so it's hard to get a gauge day to day, week to week on what's actually happening. But what we saw last year was a lot of money coming into XLF at the beginning of the year. And then middle of the year, we started to see a lot of outflows. And if you think about what happened last year, there was this anticipation that interest rates were going to rise. That should benefit net interest margins. And so therefore, financials would be an interesting trade. What we saw was that, yes, interest rates rose, but we didn't get a steepening of the yield curve. In fact, we got inversions in different parts of the yield curve, which is not positive for net interest margins. And then people started to move out of financials last year. So it remains to be seen if we see flows from banking stocks into broad-based financial stocks. And I think more importantly, the net interest margin story is interesting because that's ultimately what was the undoing of Silicon Valley Bank is net interest margins went against them. They weren't beneficial when interest rates were rising.
But it was interesting because we were often talking about here that the assumption that as rates go up, this is good for the big banks, but they weren't necessarily rallying. And it was a little bit, not a little bit, that was a lot of a disconnect. It didn't quite make sense.
Sure. So the sort of core business model of a bank is you borrow short, you lend long. But if you've already lent a lot of money long by buying bonds with really low interest rates, and then you're borrowing at higher rates than what you've lent, that's not good. And the benefit of being a large, diversified financial institution is you have capital markets businesses, you have other businesses to augment that traditional lending business, and in theory, you have sophisticated risk management in the form of swaps and other various mechanisms.
Right. And you brought up the OUSM for small caps, and that I thought was interesting because we keep talking about how small caps perform, what that could mean for large caps. What is it telling us when you're looking at the flows specifically for small caps?
And just have about 25, 30 seconds.
Okay, so I think the idea is that small caps in theory are less exposed to international markets. So with the dollar having been strong, there was a small cap trade on. Historically, small caps can be very risky. 30% of the Russell 2 just doesn't make money. So if interest rates are higher, then investors need to maybe take that passive exposure to small caps and start to reevaluate and filter that universe down for quality and income.
Well, really great to get some time with you, and hopefully you'll come back. Paul Bayaki, he's Chief ETF Strategist at SS&C Alps Advisors, joining us here in our Interactive Broker Studio. Just about 10 minutes left to go. We have stocks pretty much holding on to their gains. You are listening and watching Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet with a look now at our top corporate stories. We've got Amazon laying off an additional 9,000 employees, adding to cuts that were already the largest round of layoffs in the company's history. Amazon shares, they're lower now by 1.3%. CEO Andy Jassy announced the cuts internally today, saying they will occur in coming weeks and primarily affect Amazon Web Services, Human Resources, Advertising, and the Twitch live streaming service groups. Shares in First Republic plunging again today as S&P Global cuts its credit rating for the second time in a week. Right now, First Republic is down by 46.9%. The FDIC has extended the bidding process for Silicon Valley Bank. Offers now due by late Wednesday. And with more, here's Bloomberg's John Tucker.
Charlie, the FDIC says there's been substantial interest from multiple parties, and the FDIC and the bidders need more time to explore all options in order to maximize value and achieve an optimal outcome. The regulator says to simplify the process and expand the pool of potential bidders, the FDIC will allow parties to submit separate offers for Silicon Valley Bridge Bank and its Silicon Valley Private Bank subsidiary. The Bridge Bank was set up by the FDIC to take receivership of SVB's assets and liabilities. Silicon Valley Bank collapsed into receivership earlier this month after its long-established customer base of tech startups grew concerned and started to yank deposits. Charlie?
And that's John Tucker reporting, and those are the company stories we're following this hour. I'm Charlie Pelletan. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. I'm Carol Masser along with Jess Metton, and we've just got about just under 4.5 minutes left in today's trading session, and equities look like they're taking, well, they took another leg up, just rolling over here, just bet up 1.2% on the Dow, so that's where you're seeing some performance, I feel like, in the safer plays, if you will.
Definitely, you're looking at the S&P 500. Actually, all 11 industry groups are higher, led by materials and energy. If you look at technology, up just 0.2%, but still, you would think that the market would have reacted in a bit of a different way, right? Especially after over the weekend, the news with Credit Suisse and obviously UBS.
Right. No, and I think what's interesting, too, and I think we've brought this all here at Bloomberg into the conversation, is that, you know, the great financial crisis gave us a playbook of different things to do, whether it's through global central banks, individual banks within, you know, the private sector, and what we can do. So we go into this as we see these troubled banks, what we can do to help shore them up. And I feel like they've kicked into gear very quickly over the last week and certainly over the weekends.
That's exactly what portfolio managers have been talking to me about, especially yesterday as I was speaking to them as everything was unfolding. And they said they felt like this feels just a lot different in 2008 when you had these big banks trying to survive on their own, whereas now they're stepping in and they want these smaller regional banks to survive, and they're doing what they can to help.
Yeah, no, it's fascinating to see the likes of a Jamie Dimon and others certainly talking with regulators to figure it out. And to be fair, you know, if sentiment starts to sour, then it spreads as well, even to those that many would say are solvent and not to be worried about within the banking community. But it's so quickly, as we keep talking about, psychology quickly turns into a fundamental way of thinking, and that can certainly change the dynamic in the financial markets very, very quickly.
Definitely. And then speaking of Jamie Dimon, stepping up again today, trying to help First Republic after last week when JP Morgan and these other big banks tried this rescue proposal. Now they're coming back in. They're trying to convert deposits into capital. So trying to have another lifeline here for First Republic. So you're seeing them not giving up on this bank, Carol.
Yeah, and I mean, but it's just getting so beaten up today.
It is.
And again, another down day. But you do see it, the headlines, you know, certainly coming across throughout the last 24 hours in terms of steps by global bankers, by institutions here in the U.S., to shore up the financial system. All right, everybody, just a few minutes left in the trading session. Jess and I are going to head over to Romaine and to Katie. We're going to wrap up the trade on this Monday. Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with Carol Masser and Jess Metton. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Carol Masser.
Yeah?
Traditionally, we celebrate the first day of spring on March 21st, but astronomers and calendar manufacturers have now said that it actually begins on March 20th.
This is what you've been doing in the last 45 minutes.
It's all he's talked about is when is the spring equinox.
We've talked about nothing else.
Well,
is there
I'm
a banking crisis?
so happy that you're focused on that.
Yeah.
I don't know that I want to say crisis. I think we have to be careful, right? But we certainly have seen nervousness within the banking sector, and you've got, you know, both.
I'll call it a crisis. How many banks? How many banks have gone under?
3, but I mean, right? There's some banks that are doing okay. You know, and I'm looking at the S&P 500 investors coming back into the market. I mean, time will tell. Crisis, panic, reset. I don't know, Jess, which word?
Only one building catching on fire. Then is it not like a fire?
It's just a fire.
It's a fire, but I mean, the whole town ain't going over, going under.
That's true.
Yet.
And Carol and I were actually just speaking with Allison Williams, who's a senior analyst at Bloomberg Intelligence, talking about just how important it is for investors' sentiment around these deposit insurance, especially when you're seeing First Republic stock getting beaten up again today, even as these bigger banks, like when it comes to Jamie Dimon of JP Morgan, trying to step in there. So really crucial as all of this is unfolding again ahead of that big Fed meeting on Wednesday.
One thing I do want to point out, and I thought this was interesting, you actually did have, I guess, effectively the de facto reopening of the credit markets today. You did have Duke Energy come to market, Centerpoint come to market as well. Of course, both investment-grade issues. But remember, we had gone 6 days where we had a complete freeze here. So maybe that is a good sign, and it shows that investors are getting a little bit more comfortable with where we are right now. You're hearing the bells ringing here in New York. The Dow Jones Industrial Average higher by almost 400 points, or about 1.2%. The S&P higher by about 35 points, or 0.9%. While the NASDAQ Composite is higher by 45 points, or about 0.4%. The Russell 2000, though, that's your relative outperformer on the day, up by about 1.1%. And we should point out the S&P 400 mid-caps, which include a lot of those banking stocks, those regional bank names, up 1.7% here on the day, Carol.
All right, we're going to get into the industry groups in just a moment with Katie, but I'm just looking at the S&P 500. Yeah, most names in that index higher today, everybody. 440 to be exact, 62 to the downside, Katie, 1 unchanged.
And if you look at the industry groups, it's pretty much buying into that idea that this is a pretty broad-based rally, at least for today. You look at what's leading it. You have insurance up at the top, then you have energy, materials, all in the green. And we have a lot of bars here, that color. But if you get to the bottom of the screen, you do have software, you do have transportation down, Carol. So not everyone was singing the same tune.
No, but a lot of green there. So let's get to some of the individual gainers. I had to go to UBS. The ADRs that trade in the U.S. at their highs up 8.6%, closing, though, with a gain of about 3.3%. We know the story, of course. Its acquisition of Credit Suisse, also getting billions in central bank and state support, but of course that happening over the weekend. But those ADRs up in today's trade. New York Community Bancorp, I think, Katie, you were talking about this earlier on TV, up almost 32% in today's session, soaring by a record in the trade, upgraded by at least 2 analysts following its agreement to take over Signature Bank's deposit, also some of its loans, spending about $38 billion to do so. So certainly an outperformer there. And Enphase Energy, this is just top of the NASDAQ 100. That's why I wanted to share it with everybody, because there's stuff going on beyond the banking sector. Upgrade to outperform from market perform at Raymond James. This is for Enphase Energy. They say the stock's multiples now look more reasonable, welcomes the solar equipment makers' expansion in Europe. Stock, though, still down about 27% year-to-date, Jess.
And looking at the decliners, have to start off, of course, with First Republic, looking at that stock down nearly 50%. So this did come even after we were just talking about this rescue proposal, again, by JP Morgan's Jamie Dimon, trying to convert these deposits to capital. But if you branch this out and just look over the past 2 weeks, that stock's down around 90%, and this does come, as we all know, a day after S&P did cut its credit rating deeper into junk for the stock. But moving over and look at the ADR for Credit Suisse, if that stock down over 50% today, down close to about 53% after UBS obviously did agree to buy Credit Suisse for more than $3 billion. We've been talking about that all yesterday as well as today. And I have to point out what's happening with Bed Bath & Beyond. Looking at that stock right now, sinking more than 20%. It's actually below $1. It finished around 81 cents. So that does put its financial deal at risk, and it does come in the wake of this plans for a reverse stock split, and shares are getting booted from the S&P Small Cap 600 index.
It'll be interesting to see what happens over the next couple of days in this market as we wait on that big Fed decision on Wednesday. A market, of course, that is flipped with regards to its rate expectations. You take a look at the yield space here on this Monday afternoon, and we did see yields creep back up just a little bit, about 12 basis points on the 2-year yield, 8 basis points on the 5, and you're looking at roughly about 6 basis points on the 10-year yield. Definitely well below where we were just about a week and a half ago or so. But, of course, all that could change on a dime depending on what the Fed does, and more importantly, Katie, what it communicates on Wednesday.
Exactly, and it really feels like the 2-year Treasury yield has been the epicenter of all of this, at least if you're talking about the bond market. I mean, it's very rare that I'm paying more attention to the very short end of the curve versus the benchmark 10-year yield, but that's the kind of market we're in.
Yeah, the volatility has just been, unbelievable. But it is a reminder, as you said, Romaine, things can change, depending on the headlines that are crossing. And so this is something to think about, that, whether or not we stay at these levels, we will see ultimately.
And Carol and I were just speaking with Liz McCormick of Bloomberg News, talking about the psychology around a lot of these trades and a lot of people who may not have been around in investing during the global financial crisis. There's still this sort of mentality of buying the dip. And if you're looking at the broader markets today, not necessarily reacting the way markets would have thought, given what happened over the weekend. We could say the same thing, right? Last week with how markets ended up finishing the week with the NASDAQ 100 posting its best week since November.
This gets back to the idea here of the role of regulation. And we were speaking with Jillian Ted over at the Financial Times a little bit earlier on the TV program. And this idea that really since the financial crisis, this has been a market that, if not completely driven, certainly supported by government policy, whether it's the Fed or whether it's fiscal policy itself. And there's a lot of concern that we're sort of headed back in that direction, that if the Fed and the other central banks do need to step up with more liquidity, we're basically back to square one.
Yeah, I mean, this is troublesome. Like, the one thing is, I mean, it's been great, right, to kind of calm certainly the market fear, but it does make me wonder, well, wait a minute, is our financial system not sound that we're needing all of these measures? I mean, this is where I want to understand these balance sheets and make sure that we understand what risk exposure, ultimately the financial system has.
Well, on the flip side, to push back a little bit, what we've seen from regulators last weekend, specific to the U.S. here, I mean, did we really want to find out if we didn't have that backstop, that really forceful step in by the government, by the Fed, et cetera, et cetera? I mean, we've learned that this is really about psychology. When you have a crisis of confidence, what happens to some of these smaller banks? We've already seen bank runs. I don't know. I sympathize somewhat that they are in a tough spot here.
Yeah. And Katie, you and I have talked a lot about financial conditions and times they've tightened and then obviously the times they've loosened, but it has to make you wonder, when you do see the equity markets resilient like this, does that make it a little bit tougher for the Fed as far as some of those conditions not tightening maybe as much as they thought that they potentially would?
I am curious, though, about, I mean, whether moral hazard or what do you want to talk about, but just really the idea of sort of what a free market is supposed to be. And I get it. You don't want to let banks fail. You don't want to let all the depositors lose their money. But, you know, this is, I don't know, this is kind of what capitalism is supposed to be, right? It's supposed to be the market sorting this out. And we've seen time and time again that that's not really what we have.
Right, exactly. We get into trouble.
Yeah,
like,
I know.
There's nobody as a backstop. No, but and I understand it. There's measures to kind of calm the system because everything is really okay, everybody.
Yeah.
And then there's measures that mask maybe problems. And
all I care
that's
about,
the
Carol
concern.
Master, as long as all the venture capitalists out in Silicon Valley are okay, then I can sleep well.
I mean, but to that idea of moral hazard, backstopping the depositors, I mean, there's an argument that can be made against Silicon Valley Bank that their depositor base was way too concentrated, but those venture capitalists, et cetera, the tech bros in their vests where their deposits were backstopped, I mean,
if the regulators...
What about the ones who cried, who so basically yelled fire in a crowded theater? What about them?
It's a good question.
I won't name them.
Okay. The problem is if the accountants don't get it, if the executives don't get it, if you don't have, chief risk officers, if you have central banks that are saying there are problems, but then there's no repercussions or accountability, then there's something wrong with the system.
And now you got every congressman coming out with some little, half-baked bill that they want to do this and that. So now we got a year of this.
Yeah, and we still have on the eco calendar.
Happy spring equinox.
Since we keep talking
tomorrow.
We keep talking about spring, but it's spring home buying season coming up, but we're actually getting a ton of housing data this week. So that's something else beyond all of this that I'm going to be keeping my eyes on this week.
I love you guys.
I love you
Where's
too.
Tim? Is he? You just drove him away, Carol?
He's watching right now.
No.
I do that to people. What can I tell you?
All right. Hopefully he comes back.
All right. We will see you again tomorrow. All right. That's a wrap, guys. Our cross-platform coverage, radio, TV, Bloomberg Originals, and of course on YouTube. We call it Beyond the Bell. We will see you again, same time, same place tomorrow. banking, and rightfully so. But let's get a feel of how this change in sentiment over the past couple of weeks, or at least this new narrative, if you will, might be impacting consumers and retail. With us right now is Sharon Price John. She's president and CEO of the publicly held small cap Build-A-Bear workshop, back with us via Zoom in New York City. Sharon, nice to have you here with Jess and myself. Last time we talked, it was more than a year ago, December 2021. What's changed for you in your business, and what's on your purview, if you will, in the last 12 to 15 months? What's changed?
Yeah, well, we've continued to post record results. I mean, we just announced our year end on March 9th, and we're happy to be able to share double-digit improvement in both the top line and the pre-tax profit line, with our top line up about 14% and our bottom line up about 22%. And that we had seen at that point continued momentum in the business at first quarter year to date. And but that's not what's changed. That's what's remained the same, in that last year, 2021, was a record profitability year for us, and we eclipsed that in 2022 with another record profitability year. What's changed is that we've evolved so much as a company, in that we have a much broader addressable market. We appeal to consumers for different reasons for shopping, not just which would be a typical type of event for us, which would be a birthday for a child, but now from the adult consumer, what's called kidulting, a big trend with gifting and adult-to-adult gifts. A lot going on with Build-A-Bear, a lot of collectibles. We have a lot of fun licenses, like most recently announced Ted Lasso Bear, but things like a Deadpool bear or Matrix bears, Friends bears.
How well do those kind of bears do?
Really fun.
Like how well? I mean, are they profit drivers, or give me an idea?
Well, as a publicly traded company, clearly, one of our objectives is that we choose to do things that hopefully are profit drivers. Yeah. But the business now has, as I noted, when I speak about it having a broader addressable market, I don't mean that that's not meaningful for us. About 40% of our sales are now to teens and adults. And yes, those licenses often clearly they're going to have a royalty associated with them, if that's the impetus for the question. But they also generate generally a little higher price point as well, because that consumer has more latitude in the way they think about it. At the same time, we balance the portfolio with very accessible prices for kids, particularly with our birthday treat bear, where you can come in at the month of your birthday and pay your age to get the birthday treat bear. So if you're turning 2 years old, you can get an entire Build-A-Bear special 101 heart ceremony stuffing experience for $2.
That's pretty cool.
Your products have definitely evolved with the tastes of children today. So when you think of Super Mario Brothers or Paw Patrol, Harry Potter, and I know a lot of the accessories can definitely add up quick. So with a strong earning outlook ahead, do you think this really tells us about the direction of the economy if consumers are still willing to spend on discretionary items at specialty retailers like yours?
Well, first of all, we don't think of ourselves as just a specialty retailer. We think of ourselves as an experiential brand and an opportunity for families to come together, to share memories. We're multi-generational at 25 years old. And yes, we do evolve our licenses with the times, as you mentioned. But things that are evergreen, like a Harry Potter, that appeals to a broad range of consumers. To your question, though, our accessories business is, to be able to dress your bear and make it very much your own. That's just a part of our creative process. That's how kids and adults feel empowered, by making it incredibly unique. And you can even put the sound in the bear, so it's a one of a kind in many cases. And that's, when you think about that as the experience and the takeaway and the importance that teddy bears play in the lives of children, particularly as comfort animals, a lot of psychological background on the need for that type of special relationship with a stuffed animal. I don't know if you can consider us completely discretionary.
I gotta say, for my daughter, it wasn't discretionary when she was a little kid. Hey, one thing
I say that from a vantage point of a mom of three. So some of it could be tongue in cheek, as a CEO, but there's some reality to that.
I remember going on a trip and we forgot our stuffy, and man, we had to get a new one, find a replacement one really quickly. Hey, one thing I want to ask you, Sharon, is, and I want to step back just to some of the bigger, broader macro that's going on. As a CEO of a company, you have to think about recession, consumer, retail in general, but the recent market volatility and concerns about our banking system, how has that impacted you at all?
Yeah, of course, that's very concerning. I mean, we want to see a strong economy. We want to see people in good financial situations. I can also say, though, on looking back on the last few years, there's certainly been a lot of volatility. I think some of the most tumultuous economic times in our modern history, clearly inclusive of the COVID outbreak, and even prior to that in retail, the retail apocalypse. So feels like a lot of constant changes and uncertainty, and I think that families and businesses have to be prepared for that. We're in a strong financial situation. We have very prudent financial control. We finished this year with $40 million in cash and returned $70 million over the last 2 years to our shareholders, announced a special dividend, and have no borrowings on our credit facility. So with all of that in mind, and that we did mention that we expect in the guidance that we provided from a range perspective, another 5 to 7% on the top line, another 10 to 15% profit expansion through 2023. But the reason that we feel and shared that and feel like that there is some confidence, clearly that's excluding anything entirely upheaving. But we've been able to manage as a team and as a company that brand relationship that we have with guests, and be able to pull the proper levers when needed to manage through some of these uncertain economic times. Clearly, you've probably heard as well, have we already been in a recession? Are we in a recession now? Are we going into a recession?
Right.
It's, I don't know that there's a lot of different, I would say, earmarks that are pointing in different directions. And I think that the key is to be diversified and flexible. And that's what we've been attempting to do by pivoting the company to have revenue streams in traditional retail as well as e-com, entertainment, looking for different ways to meet the needs of guests for different reasons.
Hey, hang on for a second, just quickly. Did you shift around your banking at all because of the nervousness within the banking system?
We have a very strong relationship with our banking partners.
Okay, that's what I wanted to know. You talk about expanding your revenue stream and these strategies. You've got the metaverse that you guys are certainly embracing. You're also thinking about content and linking up with Reese Witherspoon and her media company. Just got about 45, 50 seconds. Just talk to us a little bit about these strategies, if you could.
Yeah, in a brand that has sold 225 million furry friends over the last 25 years, and when you understand that each one of those furry friends represents a story, we're really a storytelling company. So when you think about the extension and expansion of our brand and our business into the entertainment arm and the content-driven arm, it's not really that much of a stretch from that perspective. So yes, Hello Sunshine is Reese Witherspoon's company. We did announce a feature film deal. We also have Merry Mission, our Christmas holiday. This is a particular property that we launched years ago, starring Glisten. Will be out this holiday as well in an animated feature, and we'll be launching the Build-A-Bear feature documentary with award-winning documentarian Taylor Morden later this year. So we have a lot of different ways to connect again with a broad base of consumers, and to monetize the value and enormous equity of the Build-A-Bear brand.
Sharon, so good to check in with you. Sharon Price-John, CEO of Build-A-Bear Workshop, joining us right here on Bloomberg Business Week.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We check markets all day long here on Bloomberg. I'm Charlie Pelletan. A relief rally on Wall Street today. The Dow, the S&P, NASDAQ all advancing. In fact, the S&P did close close to session highs. Stocks advanced as regulators worldwide rushed to shore up market confidence. All 11 groups in the S&P 500 did advance today. S&P up 34, a gain of 0.9%. We had the Dow today up by 382. That was a gain of 1.2%. NASDAQ up 45. That was a gain of 0.4%. 10-year yield at 3.49%. The 2-year, 3.95%. Spot gold down $10 the ounce to $19.78, down 0.5. And crude up today by 1.1%, $67.50 a barrel. Bottom line here, stocks did advance on this back-to-work Monday. The S&P today up by just about 0.9%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Jess Metton live in our Bloomberg Interactive Brokers studio, streaming on YouTube and on Bloomberg Quick Take. And I feel like throughout the day, Jess, you could look at the Bloomberg, the most read stories, just about every one of the top 10 had something to do with the bank news over the weekend, big banks, the regional banks, or how it was impacting markets.
Definitely, and it feels like that the last week or so, right, as far as the top news that's on there, and especially shaping markets, but still overall looking at the broader U.S. equity markets holding up quite well despite all of this turbulence in the banks.
We are continuing to watch it all and writing specifically about Silicon Valley Bank in the current issue of Bloomberg Business Week, but really looking at what's going on in the banking sector overall. Bloomberg New Economy Editorial Director and Editor-at-Large Eric Schatzker back in our Bloomberg Interactive Brokers studio. We are all looking at this from different angles, you know, Eric, and trying to be like, okay, is this, you know, another banking crisis? How are you seeing it now that we're more than, 1 week in from Silicon Valley Bank's collapse?
Well, I have a few thoughts. Let's start with everything is systemic.
Mm-hmm. Yeah.
That seems to be one of the clear takeaways from the manner in which regulators have acted here in the United States and in Switzerland. Of course, we know Credit Suisse was categorized as a globally systemic bank, a G-SIFI, but regulators clearly took the same approach to dealing with Silicon Valley Bank. As you've been discussing with our colleagues all day long, people are asking questions like, well, why didn't they let them fail? Isn't that what's supposed to happen?
Yeah, we just had a big debate with our TV
Yes.
colleagues over this.
And so the answer to that is no, because everything is systemic. There are potential knock-on effects to even the failure of the 16th largest bank in America, let alone one of the top 3 or 4.
Mm-hmm.
That seems to be the conclusion regulators have drawn. Secondly, and it's very much a related point, they want to act sooner than later, and maybe that is a lesson from the great financial crisis. They stepped in very quickly with support for the entire banking industry in the weekend immediately following SVB's collapse.
Right.
And in Switzerland this weekend, it's not as if Credit Suisse was in the same situation. There was a risk of depositor flight, but depositors hadn't actually fled. And yes, there was a risk that more of its wealth management customers would stampede out the door. But that takes a little bit of time to play out. They simply weren't willing to wait. And this, too, sets a precedent for the future. And then the third thought that I had, which is somewhat unrelated, is what do all these liquidity backstops mean for monetary conditions and financial conditions? We know that the Federal Reserve and the European Central Bank, and for that matter, the Swiss National Bank and the BOE and the BOJ, they've all been trying to tighten conditions to control inflation.
ECB
Now,
last week.
you have, for example, the Fed not haircutting the assets that banks pledge when they're borrowing from the discount window. Well, if it were applying a haircut, then banks would only be getting, who knows, 85 or 90 cents on the dollar for every dollar of assets pledged. Now they're getting 100 cents. So in a sense, not to pun on the word sense, but there's more liquidity, a little more liquidity, who knows, a few percentage points more going out from the Fed.
Right.
And I cannot, in my head, work out all the manners in which that finds its way into the economy, but in theory, more liquidity is inflationary.
And when you're thinking about the balance sheet, is that essentially a way of them being able to ease conditions, but then still being able to have the other tool by raising rates as well to try to fight inflation? Because it's almost like you have it in two different forces there moving when you're thinking about the balance sheet not tightening anymore, but then they could still be able to
They're
still
trying
raise
to
rates.
accomplish two things, which in the context of inflation may be opposed to one another. Save the banking system and fight inflation. And saving the banking system may serve to undo some of the inflation fighting effort. And that, of course, has to be on the minds of policymakers and makes you wonder whether that will be factored into the decision that they're going to announce in a couple of days' time.
When you step back and you think about, and I know I've asked you a couple of times because you were here, reporting all over the great financial crisis, but I mean, is it different in terms of when Lehman was let to fail versus maybe have letting Silicon Valley Bank to fail? Is it, or we just don't know?
We don't know. Clearly, a lesson from Lehman's failure is wanting to avoid unintended consequences.
Right.
That we can only surmise that was clearly, front and center for regulators, not this past weekend, but the weekend before when they were bailing out SVB depositors. Sure. But the important one, there's so many distinctions to be drawn between what we're dealing with now and the great financial crisis, one of which is that the banking system was, to a degree, rotten to the core back then, right?
Exactly.
We had real estate assets littered throughout the financial system that in many cases were worthless or just worth a lot less than they were when they were underwritten. And that isn't the case right now. The risk profile of the financial system is quite a bit different. I was about to say that banks are on the whole well capitalized, but then of course we just had more than one fail, and they had to be seized by the FDIC. But in general, that does appear to be the case. Those are, as we've discussed and as you've discussed with other people, the specific circumstances around Silicon Valley Bank or Signature Bank or First Republic are somewhat specific to those banks. They had a lot of non-insured depositors. Most of the banks in this country, and in particular the larger banks, have very, very well-diversified deposits.
Right.
And huge percentages of which are already insured. Now, insured at the $250,000 level, we have a $250,000 cap on insurance because the last cap we had, $100,000, proved to be too low after the failure of IndyMac in 2008.
Right.
So they raised it to $250,000 after that bank failed. And of course, I and others are wondering whether that deposit cap or the insurance cap on deposits is going to be raised again because these banks proved, at least, yes, or suggest that the cap wasn't high enough.
But SVB reminds you that people had millions of dollars, right?
Yeah, there were lots of depositors at SVB who had many millions of dollars on deposit. They were either companies or they were venture capital firms or whatever the case. And that's why so many people, and you hear the tension in the conversations you have, that's why so many people are angry because they look at this as a bailout for Peter Thiel and Mark Andreessen and others in that community.
We know a lot about the issues with Credit Suisse in recent years, but do we know specifically what concerning things that UBS saw that required them to raise their demands over the weekend for that deal?
Uncertainty. They have a very large and complex balance sheet. It's difficult to value. We are living in very uncertain times. Difficult to value over a weekend, or whether they began the exercise last Wednesday or Thursday, it doesn't matter. 4 days is not enough for UBS or anybody else for that matter. Doesn't matter who you call in, BlackRock, whomever, to value these assets. It's very difficult to get a handle on the value of those assets in that short a space of time. And so why were they demanding these concessions? Because it's still possible that even with this $9 billion backstop or 9 billion Swiss franc backstop from the SNB, they're going to have to end up eating more than the initial $5 billion of potential losses, which they have agreed to underwrite under the terms of this deal.
It's pretty amazing. 30 seconds left here. So what are you keeping on your radar? Is it just a case of another bank popping up to kind of get an idea of where this goes?
We have to see what happens with First Republic.
Yeah.
The rescue effort is ongoing. That is largely a private sector-led rescue effort, and it hasn't stopped the bank's shares from cratering yet again today.
Right.
That's probably the first thing on my mind. And then it does appear as though this rescue of Credit Suisse by this shotgun marriage with UBS at the behest of Swiss regulators has for the time being put that question to rest. But honestly, who knows?
Yeah.
It doesn't feel exactly like 2008,
and yet.
but it feels a little bit like 2008. We don't know what's coming.
Yeah, exactly. Thank you so much. So appreciate your perspective, as always. Eric Schatzker, editorial director of Bloomberg New Economy, joining us here in our Bloomberg Interactive Broker studio. I'm Carol Massar, along with Jess Menton. You are listening and watching Bloomberg Business Week. Let's get to World and National News. We're going to head off to D.C., Washington, D.C., and our 99.1 newsroom, and Nancy Lyons. Hey, Nance.
Thanks, Carol. Secretary of State Antony Blinken is reminding Chinese President Xi Jinping, who is now in Moscow, that his so-called peace plan for Ukraine begins with respect for its independence and territorial integrity.
Blinken said Xi's meeting with Vladimir Putin, who stands internationally accused of war crimes, suggests
China feels no responsibility to hold the Kremlin accountable for the atrocities committed in Ukraine. It would rather provide diplomatic cover for Russia to continue to commit those very crimes. Calling for a ceasefire that does not include the removal of Russian forces from Ukrainian territory would effectively be supporting the ratification of Russian conquest.
Blinken added that an effort to promote a ceasefire now would only allow Putin to regroup his forces and resume the war at a more advantageous time. In Washington, Irv Chapman, Bloomberg Radio.
The Secretary General of the United Nations is sounding the alarm on climate change following the release of a new report from an intergovernmental panel on the topic. Antonio Guterres says all countries, especially the industrialized ones like the U.S. and China, need to step up their efforts to reduce greenhouse gases.
This report is a clarion call to massively fast-track climate efforts by every country and every sector and on every time frame.
Guterres calls the report a survival guide for humanity. Earlier today, President Biden vetoed a plan to block a bill that would allow portfolio managers to look at climate change and other environmental issues when making an investment. It's his first veto as president. Biden says environmental issues can have a material impact on markets. And speaking of pensions, the French government has survived 2 no-confidence motions after pushing through Emmanuel Macron's unpopular pension reform bill that raises the retirement age in France from 62 to 64. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
Connection lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
4:40 on Wall Street. I'm Charlie Pelletan. We do check the markets all day long at Bloomberg with the Dow, the S&P, NASDAQ, all advancing today. The S&P closed very close to session highs. Regulators worldwide rush to shore up market confidence for the recent financial turmoil, spurring speculation on a slower pace of tightening from major central banks. All 11 groups in the S&P 500 did advance today. The S&P was up 34 points, a gain of 0.9%. Dow Industrials today up 382, a gain of 1.2%. NASDAQ today up 45 points, a gain of 0.4%. The 10-year at 3.47%, the 2-year 3.97%. Spot gold down 0.5%, 1978 the ounce, while West Texas Intermediate crude oil was up 1.1%, 67.47 a barrel on WTI. Now, what about the overall market backdrop and what is on the minds of clients? That question today for Paul Bayaki, Chief ETF Strategist at SS&C Alps Advisors, who is our guest right here on Bloomberg Business Week.
And I think the idea is look, these are in some cases idiosyncratic dynamics, but in other cases they're a symptom of what has been a pretty dramatic change in capital markets dynamics that we haven't seen for quite some time. And so I think some people are just sort of in wait and see mode.
Credit Suisse Group told staff that promised bonuses and pay increases will still be paid as the bank seeks to keep, quote, business as usual after a tumultuous week that ended in a takeover by its fiercest Swiss rival, UBS. Today, UBS shares picked up 3.3%. Credit Suisse down 53%. Again, recapping stocks higher. S&P up 34, a gain of 0.9%. I'm Charlie Pelletan. That is a Bloomberg Business Flash.
All right, great to have you back, by the way, Charlie.
It is delightful to be back. What a week last week. What a week to be. But, you know, I got to tell you, where I was, we had transit strikes in the United Kingdom. Paris was an absolute mess. I mean, there was all sorts of news on that side of the Atlantic.
Did you ever think it's wherever you go, you just create problems?
Yeah, as a matter of fact, my wife will tell you that without a doubt.
No, we love you. We love you. Welcome back. Charlie Pellet there. All right, folks, we've seen this movie before. Big tech company cutting jobs again. Last week it was Meta. This week it's Amazon laying off an additional 9,000 employees, adding to cuts that were already the largest round of firings in the company's history. Stock down on the news, down about 1.25% in today's session, still up roughly 16% year to date. So let's get to it with the latest on the company. Bloomberg's intelligence senior technology analyst Anurag Rana joins us via Zoom from Chicago. Anurag, good to have you here with Jess Metten and myself. So I'm trying to think. First of all, let's go through the news. Why did they have to cut another round of jobs?
Part of the update that they gave that they were, going through an operational planning and trying to figure out how much excess capacity do they have. And they did, the first round a couple of months ago, and then the other review wasn't completed. When it was completed, they found out they could, eliminate another 9,000 jobs. And that's really the rationale that was given by the company.
So is this smart management in your view, saying, okay, we still have too many workers, we got to cut back, rather than doing a massive layoff and maybe figuring out they cut too much?
One could argue that they just took their, time in making sure that they don't overreact at the first go. Our read on this is we don't think the fundamentals of the cloud business are recovering at this point, which is partially the reason why they had to undergo another round of layoff. They may have avoided it if we saw a rebound in stock growth. The cloud growth, I would say. That could be a reason, but we won't know that till, the end of April when they announce their results.
Anurag, where specifically were jobs cut in this latest round versus compared to what we saw earlier this year?
Yeah, so they highlighted 4 divisions, AWS being one of them, advertising being one of them, Twitch and PXC, which is their human employee experience segment. Now, from a revenue side of it, AWS is far bigger than anything else. We think the majority of the cuts could be in that area. They didn't break up by segment, but our thesis is that that's where we saw a bulk of the cuts.
Is that troubling to you? Because we talk about AWS, how important that is to Amazon, certainly top and bottom line in growth.
Yeah, but if you were to say that over the last few years, the revenue is more than doubled and their employee cases, base would have doubled as well in order to keep up with that, again, if they, let's say for the sake of argument, they have 100,000 employees and they, let go, let's say 10% of that. I mean, it is logical if you see the rate of sales growth go down. Our argument is if the cloud still has a long runway in the long run, when that growth comes back, they're going to go out and hire a lot of people back again.
And if you look at its stock today, it was down a little more than 1%, but still year to date up about 16%. Do you think its stock price will potentially remain challenged in the near term due to slowing AWS sales, inflation, or do you think it might be a little bit counter to that? I mean, we've seen even Meta had quite the rally since obviously it announced more job cuts last week, but even since November, Meta's stock had been up more than 80%. So I'm wondering kind of what this means for the trajectory for Amazon stock price.
Yeah, one of the things you have to really look into it is relative valuation. I mean, the Meta is a far more profitable company. It's trading at a much different multiple than what Amazon's trading at. For Amazon to turn around from a stock point of view, one of the things they have to really do is to really look at the profitability of some of their segments, and we have no idea when that's going to turn around, frankly.
It's interesting. I was looking at what Jassy, the CEO of Amazon, said in a memo that was published to Amazon's corporate blog. Here's the quote: "Given the uncertain economy in which we reside and the uncertainty that exists in the near future, we've chosen to be more streamlined in our cost and headcount." When a CEO, I always find it so important, Anurag, in terms of what the CEOs have to say, certainly in an environment where we're worried about banks and bank stress and just trying to figure out what happens to the economy and recession, no recession, landing, no landing. We're waiting on that Fed meeting this week. When a CEO like Andy Jassy says that and uses uncertain and uncertainty twice in a sentence, how do you read it and then cross that against the fundamentals at the economy and the balance sheet?
I would argue that over the last 5 years, or I would say more than 3.5 to 4 years, tech companies have hired very aggressively, thinking that this particular growth cycle will never stop. And that's, I think, most of them are kind of paying for, sudden abrupt spending in technology right now. If you go back to the history of Amazon, really the ethos of the company, it has been a very frugal company in terms of spending since the founding of the company. I think, and Andy's been around with Jeff Bezos since the beginning, or near around the beginning. So I think, he's reminding people that we got to be very conscious when we are not looking at, revenue growth that is in the same that it was in the last few years. We just have to mind our expenses. And frankly speaking, he's right. Nobody knows what's going to happen to enterprise tech spending in the second half of this year, whether we're going to see any recovery or no recovery at all, and whether this is going to be either a 2024 story or a 25 story.
And we've seen so many cost-cutting efforts, whether we're talking about Amazon or Meta, Microsoft, Salesforce, Intel. You can name your big tech company this year. We've seen it, or in the past 6 months. I'm wondering how much further do those efforts have to go to shore up investor confidence about these cost-cutting measures? And we are talking about big tech companies and growth stocks.
One of the arguments would be, if growth doesn't come back, you're going to see another round of layoffs from a lot of them. There is no one size fit all over here. If you look at a company like Microsoft, in the last 5 years, they've doubled their headcount from 100,000 to 221,000 before they announced a 5% layoff. That's a 10,000 person layoff. So if you are going out and looking at a time frame of slightly longer than just 1.5 years, that these companies have hired very aggressively, this is bound to happen.
Yeah, I do feel like, Anurag, and the conversations that we certainly have had over the last year or so, it does feel like many of the companies, especially within the tech universe, it's a bit of a reset post-pandemic. Is that fair to say? And just got about 20 seconds left.
Yeah, absolutely reset. This is really a reset because we thought this is not going to stop. For the first time in 5 to 6 years, we are seeing some slowdown, and job cuts are just a part of reality at this point.
All right. Well, good perspective and just putting this in check. Anurag, thank you so much. Anurag Rana, he's Senior Technology Analyst at Bloomberg Intelligence, joining us via Zoom in Chicago. And as we mentioned, shares of Amazon just a little bit lower in today's session. I mean, in a market where we saw a lot of names, certainly in the S&P 500 higher, Amazon, one of the laggards, down about 1.25%. But to be fair, it's been on a tear this year, up about 16%.
It definitely is. And even though these measures are painful, obviously, for people employed, still we're seeing a lot of companies rewarded when this has happened.
This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 4:53 on Wall Street. Sempra Energy and ConocoPhillips will proceed with a $13 billion liquefied natural gas terminal in Texas, the latest in a wave of export facilities to begin construction following the war in Ukraine. Norwegian Cruise Line Holdings says CEO Frank Del Rio is retiring. And with more on that story, here's Bloomberg's Steve Rappaport.
Charlie Del Rio will step down from the top post and his seat on the board on June 30th after a 30-year career in the cruise industry. Norwegian says he'll be replaced by 55-year-old Harry Sommer, who has been president and CEO of the Norwegian Cruise Line brand since 2020. Del Rio plans to remain an advisor to the board through 2025. Sommer takes the reins at a volatile time for the cruise industry as inflation and economic uncertainty raise questions about the post-pandemic travel rebound. Norwegian's outlook for the year trailed analysts' expectations late last month, and the stock has lost more than a third of its value over the past 12 months. Charlie?
And that's Steve Rappaport reporting. Indeed, today, Norwegian Cruise Line Holdings down 1.7%. Rival Royal Caribbean tumbled 0.9%. Carnival Corp up today by 0.7%. First Republic Bank shares plunged again today as S&P Global cut its rating for the second time in a week, warning that a $30 billion rescue deal had not resolved the lender's challenges. Today, we saw First Republic down 47%. And those are some of the company stories that we're following for you at this hour. I'm Charlie Pellett, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, more Business Week coming up in just a moment. First up, let's get a check on world and national news. Off to Nancy Lyons. She's in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. Chinese President Xi Jinping is in Moscow talking with Russian President Vladimir Putin on a number of topics, including a proposed peace deal with Ukraine. White House National Security spokesman John Kirby says Xi needs to represent both sides of any potential deal.
Efforts to end this conflict must take Ukraine's position into account. And so we encourage President Xi to play a constructive role by speaking with President Zelensky, which he has not done since Russia launched this invasion.
Kirby says any decision by China to provide lethal aid to Russia would be ill-advised. Xi, by the way, does reportedly plan to hold a video conference with Ukraine's President Volodymyr Zelensky after his meetings with Putin. New York Mayor Eric Adams says police are making security preparations for Lower Manhattan in connection to a possible arrest of former President Trump. Over the weekend, Trump posted on social media that he expects to be indicted tomorrow, and he urged his followers to protest. There's been no confirmation of that claim, though, from the district attorney's office, but Adams says they're doing what they can ahead of time.
We're monitoring comments on social media. NYPD is doing their normal role of making sure that there's no inappropriate actions in the city.
Again, New York City Mayor Eric Adams. Trump is being investigated in a hush money case involving adult film actress Stormy Daniels. In a related story, Republicans in the House are demanding the Manhattan District Attorney testify before Congress ahead of any possible indictment of former President Trump. Another purge is underway at Amazon. Today it announced it's laying off an additional 9,000 workers. That's on top of the 18,000 job cuts it completed last month. Bloomberg's Ed Ludlow explains what's happening.
Amazon hired at really elevated levels during the pandemic era, and they're still learning that they're having to unwind that level of hiring because the economy they find themselves in now has changed.
Bloomberg's Ed Ludlow. Other tech giants have scaled back their staff, including Google parent Alphabet, Microsoft, Dell, and IBM. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Jess.
All right, Nance, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The ERC isn't alone. It's money your small to medium-sized business may be eligible to receive for keeping employees on payroll in 2020 and 2021. Get an estimate of your company's potential refund today. Learn more, just head to getrefunds.com. All right, March, Women's History Month, as you know, and every day this month we're celebrating significant moments in women's history. So let's get your installment for this Monday, March 20th, 2023. Here is Bloomberg's Lisa Mateo.
On this day in women's history in 1852, Harriet Beecher Stowe's Uncle Tom's Cabin was published. The anti-slavery novel was born from a series of installments in the abolitionist newspaper, The National Era. Stowe expected to write 3 or 4 segments, but Uncle Tom's Cabin grew to more than 40. It was published as a 2-volume book and sold 10,000 copies in the U.S. in its first week and 300,000 in the first year. Critics questioned whether the white author had the ability or the right to speak for people of African descent. Stowe was inspired to write the story after traveling from her hometown in Ohio to a Kentucky plantation where slavery was legal. She used first-hand accounts told by formerly enslaved people, as well as other freedom narratives and anti-slavery newspapers to help with her vision. That's Today in Women's History. I'm Lisa Mateo, Bloomberg Radio.
All right, Lisa, thank you so much. Carol Masser, along with Jess Menton, live in our Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Day one of the trade down. Let's see. I kind of can't wait for the Fed meeting. You and I were just talking about this.
I know.
Like
it's
counting
just
down.
Exactly. And it's like all this anticipation, but still feels like even though it's a little under 48 hours away, Carol, still all eyes are on Wednesday and waiting ahead of that.
Rightfully so. And markets right now predicting, what, a 1/4 point hike at this point?
Yes, definitely. With those swaps are thinking a 70% chance for that. So that'll be key along with those economic projections and dot plots.
All right, everybody. Carol Masser along with Jess Menton. Stick around. More to come in the next hour of Bloomberg Business Week right here on Bloomberg Radio.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Hi, everyone. Bloomberg Business Week continuing on this Monday, live from the Bloomberg Interactive Broker Studio, streaming on YouTube and Bloomberg Originals. I'm Carol Masser. Tim, as you know, on leave with us is Bloomberg's Jess Menton here in studio. And coming up this hour, we're going to continue our coverage and really just a roundup of today's global banking headlines, what to keep on your radar as we think, Jess, about the rest of the week.
Plus, we are going to talk to founders of a VC firm who are going to dig into us about SVB and also about their book when it comes to closing the equity gap. So that's going to be an important conversation later on, Carol.
Yeah, and it's a big piece of this story, right? With the collapse of Silicon Valley Bank. All right, first up, though, a check on the day's trade and your top business stories. Here is Charlie Pellet.
Hi, thank you very much. And here's what's going on.